Welcome to the Realty Trader Talk podcast. I'm Jordan Kane, the host, sponsored by RealtyTrader.com, sponsored by Chaser Water. Today, I have a very special guest. Matter of fact, does a lot of the loans for me, previous law enforcement, previously in investment banking. So you're going to get some really good knowledge today. A good friend of mine, James Cannata. How are you, sir?
I'm well. Thanks for having me, Mr. Kane. Or sorry, like I call you through the years, Dr. Kane.
Dr. Kane, that's right. So let me ask you, because I just learned that. I had no clue that you had a previous history in law enforcement. So tell me about how that started and, a little bit of the journey.
Yeah, well, I was 20 years old, didn't want to go to college. Actually decided I'm going to be a cop. So I ended up working for the Monmouth County Sheriff's Office in New Jersey.
Okay.
And I got into the warrant unit. And first couple of years out the gate, it was great. I was number one in DUI arrest. I was 20. I was actually 20 years old, not legally old enough to drink yet. And I was number one in DUI arrests. Again, my mentality was always, look, that could be my mother or my family that you just smashed. So I always just really kind of went that route.
Look, at 20, full of piss and vinegar, you are out there just a warrant unit, I bet. I mean,
kicking indoors,
yes.
Spraying pit bulls, fighting guys. But that was the first couple years out the gate.
Sure.
Then I got I had a couple close calls.
Oh, wow.
Yeah, because I was in the warrant unit chasing guys down, and I literally sat back and said, wait a minute. I'm risking my life for, at the time, I was also number one in overtime for $41,000 a year.
Oh, wow.
And I would get the same if I was in like the warrant unit or the guys that bring the prisoners to the jail. I'm like, what am I doing here? Right. So I swapped it up, but then I got bored real quick. And then that's when I went and started studying for my securities licenses to go down to Wall Street.
So you ended up getting your securities license?
Yes. I actually worked on the 88th floor at Dean Witter, where the planes went in. Yeah.
Wow.
I was on the NYSE, New York Stock Exchange, when 9/11 happened.
Way.
But I worked in that floor where the building hit. Yeah.
That is amazing.
Yeah.
So obviously, by the grace of God, you're here today on this podcast telling the story. So you weren't involved at the time of, that tragedy that we all suffered. So how long were you in investment banking?
I was there for 6 years.
Oh, wow.
Yeah. I actually started with retail, Dean Witter, then went to Morgan Stanley when they merged, and I hated it. It was, I felt like I was like a used car salesman. I just didn't do well with the public, so I was going to quit and go back to being a cop. And I had a buddy of mine. He worked for NASDAQ, for a Goldman Sachs subsidiary called Spearleys and Kellogg. He's like, hey, we need some greenies. Let's hire you on, give you a shot. I went in there and I didn't have a college degree. I had I didn't even finish an associate's, but I went in there and all these guys were from Wharton, Duke, all these high-end schools. And the first round, they didn't hire me. And I was really upset. And I literally was like, all right, what am I going to do? I'm going to go back to being a cop. And I got a phone call from the guy who traded their foreign desk. And he said, his name was Nacho. He goes, hey, I'd like for you to come and meet me. Because they didn't hire for my department, but I'm looking at all the resumes. He goes, I don't want guys like that. I want someone with your experience. I go, what do you mean? He goes, a lot of people like to say, oh, I got killed today. He goes, but with your experience, he goes, you know how to make an instant decision, or it can mean your life or your death. And then if you win here, great. But if you die here, you still get to go home. He goes, you know what it's like to truly be put into danger. And he hired me. So I went in there and I got hired with a chip on my shoulder. Of all the class we got hired, it was like 20 of us. I ended up being the first assistant to get my own trading pad, because all I did on my train ride home, I would literally just sit back and pretend like I would get a call. I've been laughed at throughout the years saying my phone skills are kind of rough because I'm very to the point. But that was because of that. When you work on the New York Stock Exchange or NASDAQ, you'll get a call. There's a long conversation. Buy 1 million shares of IBM, take a quarter if you need it. Don't say, oh, I didn't get that. Don't say, oh, what'd you say? Slow down. Oh, how was your weekend? I don't hear that. No, it's you need to be on the show.
Fast pace.
So what I would end up doing was I would just rehearse these orders coming in to myself over and over and over again. And then my trading style, when I would trade, I was going to take these massive positions. I wouldn't do it. I would just be in, out, and clean. They used to call me Alibaba. I'd steal a little from here, steal a little from there, and then get out of the position. So, and it worked. I was real profitable. So,
Bro, I didn't know anything about that. Right? So, how old were you at that time period?
I was 25. I was a cop for 5 years, and then I was 25 when I went to Spearley's at Kellogg. Then I went through a couple of buyouts. I did well at them, and then Goldman Sachs. This is before the subsidiary bought them, and there was a lot of overlapping of different traders.
But you had your Series 7?
Oh, I had a whole football team. I had a Series 3, 7, 64, 65. I had Block Trader. I had every license you can get. So because my chip on my shoulder, I didn't have that college degree. I went to, before it got destroyed in the trade center, I went to the New York Institute of Finance and got certified for charting. I got certified for every license available. So I was like, look, I may not have a degree in Wharton, but I have more practical, technical knowledge than anybody, you two guys combined. And that kind of, that chip on my shoulders kind of moved me forward.
So when you got out of that, because I mean, that's such an interesting, before we get out of it, such an interesting business. I feel like that's kind of like, well, mortgages or real estate, you can get a license. There's nobody who can, there's not an industry, not nobody, but there's not an industry that makes more millionaires than those industries that don't have these large Wharton college degrees, Harvard, so there's a lot of money that changes hands through. I've always been interested in it. It's
my big thing is, because now it helps me now when I'm doing a lot of these speaking engagements for mortgage, when we say that there's only 3 ways to get wealthy. The first is you need to attach yourself to something that goes up in value, a stock, a mutual fund, a house. The second way is you can do it by earnings and savings, but it's going to take a long time. Or the third is just marry rich. Right? Or divorce rich, one of the two.
Right. Depending on what side you're on. Yeah.
So, but I learned that from Wall Street. A lot of good lessons I learned from there.
So did that what got you into mortgages or bring you to Florida, or how'd that work?
I ended up going from a NASDAQ, went through a buyout. All right. And then from there, I went down to the New York Stock Exchange. Completely different way of trading. And I had to almost like reinvent myself again. So going down the New York Stock Exchange, everyone sees it's all fancy and crazy, like on television. No, it's pretty controlled. But I had a guy I grew up with, Ron Pickowitz. He's like 5 seats away from the president of Bank of America, but he was running Wells Fargo from Boca to Vero Beach, and he actually sat back and said, "I'd like to get out of what I'm doing and come and so he came and visited us. The day he came to visit us, our intercom system went down. And I mean, now I had back in the day before, the mouse that goes in between 3 computers. Before it was a thing. Now it's a simple thing. We had this. I had 2 assistants, one on each side of me. And he's watching our intercom system go down, and we're yelling all back and forth because the intercom systems were down. And he's just standing there watching this chaos. And it was kind of invigorating. And he's looking at my earnings screen going up 50, 60, 100 grand, 120. He goes, "Holy smokes, you're making all this money." I go, "Yeah, I can't talk to you right now." And then when it was done, he's like, "Well, how much do you make of that? You take all that money?" I go, "No, I only get like 12% of it." And I could see the wheels going on in his head. He's like, 12% of $120,000 for a day? And I was like, "Oh, it's not always that day. I mean, like that. I mean, some days I'll make like $700, $800. He's like, "That's a bad day." So he wanted to come work with us, but we wouldn't hire him because he's analytical. Well, I then went from on the New York Stock Exchange. I worked for Charles Schwab, Bear Stearns, and then what happened was Charles Schwab. That was the last post out. He was a smart man. He hated the New York Stock Exchange. He wanted to go back to NASDAQ. So what he ended up doing was he sold our unit on the New York Stock Exchange trading desk to UBS Warburg. Now, UBS Warburg was based out of Connecticut. I lived in New Jersey. And they wanted to go ahead and only take like 5 people. I was one of the 5. But I didn't want to move to Connecticut. So they took me up to the JP Morgan lounge. I sat down. It was like the whining, dining, yeah. And I just said, I'm out. I'll take the buyout. They're like, wait, you understand? There's so many other people who want what we're offering you. I'm like, I'm out. I don't want to go through another buyout. So I took the buyout, and I'm like, well, what do? I sold everything, moved to Florida. I was too young to retire. I was just a little short to retire. I was like, I'm gonna do something. So I call up my buddy who came and visited me. He was like, oh, we'd love to hire you. And he was running Wells Fargo. So his bosses were sitting there saying, this guy's got no experience. I know you like him, you're friends with him. We're not gonna hire him. I'm like, give me a shot. They gave me a shot. And after 90 days, Wells Fargo was gonna fire James Cannata because I was terrible. I was literally, remember, I didn't deal with the public. Right. I dealt all institutional. Mm-hmm. So now here I am as a mortgage originator for Wells Fargo, having to deal with, hi, how was your day, sir? What's going on? I don't want to know part of any of this. Mm-hmm. And I hate it. I was on the phone, and this goes to tell you, even to this day, a bank, if you work for a bank, you don't need a mortgage license. Okay, a lot of people don't realize you don't need an MLS license, but you need a mortgage broker's license. So working at the bank that time, I'm on the phone with someone, swear to you, true story. All of a sudden, the guy on the other phone asked me, well, what's the DTI for whether? I don't know. I don't know what a DTI is. I'm on the phone with this man, Googling, how do you calculate DTI? Swear to you. So after 90 days, I'm like, I'm out. I'm quitting. I was going to go back to New Jersey, and I was talking to a buddy of mine who was going to work for a hedge fund. And that week, I had my little cubicle. There was someone in the other side of the office. Their file was falling apart. And you're going to appreciate this because this is how you kind of have known me as my reputation. Now, in 90 days, I was producing nothing at Wells Fargo. But in 90 days, I read all of their guidelines. And I knew them. So they're like, well, this file's going to get declined. I said, I poked my head around the cubicle and I go, oh, well, why don't you try it like this? And they're like, this guy, you haven't closed a loan in 3 months. Like, what are we going to list you for? And like, well, that could work for the guideline, but he's self-employed and the income. I said, well, wait a minute. Now, granted, I didn't know mortgages, but I knew how to do P&L statements, calculate the tax returns, asset statements. I said, well, if you take it according to the guideline, can't you go ahead and add back depreciation to do this, this, and this? They looked at me and like, we could try it. Approved. Same week, another guy had his loan falling apart. I put my 2 cents in, approved. Light bulb goes off. I was ended up, from a guy who was getting fired after 90 days and then close a loan, I ended up being, after my first year at Wells Fargo, the #1 producer for them in the southeast portion of the United States of America. And now, granted, Wells Fargo back then was not Wells Fargo now when it comes to mortgages. Now, the banks offer mortgages. They don't do mortgages. But that wasn't the case back then. So before a loan was declined at Wells Fargo in the state of Florida, it came to my desk. And all I did was say, restructure it or decline it. No realtor partners, no builder partners, no book of business, nothing. And I was the #1 guy in the southeast portion of the country. So, wow. And then I went from there to Chase as a sales manager. And that was right before the implosion. Right? The markets imploded. And what happened there was I literally got hired. They gave me a year guarantee, like a guaranteed income for a year. But if I left, I owed it back. We were there maybe 2 months. The world starts falling apart. I smelt it too. And one of the things that got me is like right before this happened, they had a sales rally in Palm Beach Gardens at the Marriott. So I go down to it, and I had all these guys come, like these regional guys from New York, knew my name but didn't know my face. And they're going, we're going to do this, we're going to do that, all these different things. I felt like I was at the carnival with the circus criers. Yeah, we got the fat lady, we have the fire swallower, all this stuff, right? And in my head, as I'm listening, the whole room, these guys were all getting excited, they're clapping, and I'm like, you don't pay me a salary. What if, to me, a king's ransom was $35,000 a year? Who are you to tell me to go make more money? And it kind of sat in me. I'm like, I don't want to work for these banks anymore. They're driven by their P&L, their margin, their bottom line, not even for the benefit of the buyer. Okay? That may ruffle some feathers, but it's the truth, and I've lived it. So I then go ahead. The world starts falling apart. I turn around at that point, and I had this older couple come to our office. And I'm not going to say who the mortgage company they're with because they're still around today. He's a broker out of Jupiter. We're approved with this broker, and I'm looking at the GFE at the time. Right? That's how far it was. Good faith estimates. And I'm looking at him going, this is great. I was like, but we need to make a sale. You know what? I don't know if this is real. I don't know if it's not real. We're Chase. We're the big name. You could trust us. And they ended up staying with me. And I sold them this product that was inferior to what they were being offered. Man, I felt like a slimeball used car salesman with a cheesy mustache. I didn't have a mustache, but I thought I still like real cheesy. And I literally went home and I made a decision and said, I'm done. So I called up the people at Chase and said, I'm quitting. You can come after me for the money you gave me or not. I don't care. They literally turned around and said to me, what we're going to have coming in this housing industry pales on what the loss we have from you. Just go. And the world imploded. The housing bubble popped. So I go out in the middle of one of the worst economic times America has ever seen. And I started a mortgage company, Mortgage Plus. And honestly, while all these other lenders and companies were going out of business, I was exploding in growth. Because why? I didn't have stated income. I didn't have stated assets. You wanted to close a loan, you need to know how to read a tax return, pay stub, calculate variable hours. You need to be able to how to figure out how to solve problems. And that's all I did at Wells. So we ended up growing, and I was in that Mortgage Plus for good amount of years, about 5-6 years. And all of a sudden I get a phone call. I was comfortable. And I saw now that the housing recovery, we go through it. But now the Department of Banking, so I was like, hey, we need to start this NMLS. Everyone needs to be uniform. And I agreed with it. But they wanted to go after the small mortgage broker. Because the small mortgage broker, in reality, when we look back, those were the ones that really aided the explosion of the implosion, rather. So they're telling me, James, why don't you come over to us? And this is this company called Acopia. And I was like, Acopia? I was like, okay, I've never heard of you guys, but listen, I knew all of the managers there. They were all the ones that I knew from Wells Fargo and Chase. They all went and worked for this company, Acopia. So I measured out the two. I said, you know what? I'm going to give it a shot. Man, that was one of the best moves I ever did. Because the small mortgage broker guy got washed out, and you had to go to this retail model. And there, while I was working for them in a branch, they was like I owned my own branch. They let me do whatever I want as long as I was profitable and I didn't break laws, which will never happen.
I remember that time. Why do you think those smaller mortgage brokers got washed out, though? Why did
lack of regulation?
Yeah,
there was a lack of regulation. It was the Wild West. Before the NMLS changes, it was here. So I saw my mortgage company, right? And I go to an event that Freedom Mortgage held. And it was through their wholesale guy who come in. They're just trying to get you the business, but it was a compliance thing. And they were trying to charge, and what the mortgage brokers were doing in the day was you would make money on the back. It's yield spread premium, YSP. But you could also make money up front in origination. And if you charge discount, these guys, it goes to your pocket. But they weren't living the benefit of the reduced interest rate. So what ended up happening was, now me and that fellow I was talking about, Ron Pickett, we started this Mortgage Plus. So we're sitting there and we said, you know what? This just doesn't seem right. We're going to go ahead and we're going to price everything like we were at Wells Fargo. Because at Wells Fargo, it was if the rate cost this price and it was lower than that, we'd give it back to the buyer for closing cost credits. Or we just lower their rate. We wouldn't put it in our pocket. All the other mortgage guys were putting it in their pocket.
So you could be a mortgage broker in a sense, charge a point and then take the point of as your own money in a
And
sense.
then get paid from the company broker too, and yield spread premium.
So you're getting both. So you're getting both sides.
You're whacking around two sides.
Right.
So now here I am. They make these changes, and all the mortgage brokers, they did it to target the mortgage brokers, and all the mortgage brokers again started panicking, and I was like, that's not a change. We've been doing that for years, but because it was it was legal. Two, it was the right thing to do. So, and I always have a philosophy: you do the right thing, and money will follow. But if money doesn't follow, you did the right thing.
So, do you think that in today's mortgage world, because there's, talks of, are we in a bubble, or, can we have this happen again? Mortgage rates are climbing. What is your take on that? Could we ever see this fall again?
Could you? Sure. I mean, I thought if COVID taught us one thing, you don't plan out for a year, right? Because January 1st of 2020, everybody had all these plans they were going to do. By March of that same year, it was all up in smoke, and the whole, you had to change everything, and who knew what was going to happen. So in theory, could it occur? Sure. But from the lending side, there are so many safeguards that are in there. Now, where I think there are problems, I'm going to get a lot of hate mail on this, but the builder market really hurt things, because there's not $20,000 in revenue in a $400,000 loan. Yet you go to the new construction community, we're going to pay the realtor a commission of what?
3%
or more.
Or more.
We're going to give you a rate buy down, plus give you $20,000 in closing cost concessions. I'm going to go, that's not even there. Where is it coming from? They build it into the price, right? So if you're building into the price, and all of a sudden you get a little bit of a housing slowdown, the first ones to fall are the new construction ones. Just go out to tradition right now. There's a lot. You start seeing a lot of short sales, because a lot of people, it's not going to collapse. They're just going to be a little bit under, because, no, correctly, they stay there 5 years or more, it'll all wash out. And that is a key number, that 5 to 7 year number. Why? Why is interest charged 5 to 7 years? Why do builders put that 5 to 7 year recapture back? Because they all know most human beings make a decision in 5 to 7 years. Hey, life changed. I have another child. We need another bedroom. Let's move. Interest rates shifted from where you're at. Let's take it out. Or let's do a cash out refinance and pay off some debts, or go ahead and reinvest the money. That's why interest is front loaded.
So I just went out to Esplanade and Tradition, and I had a buyer looking at a resales, looking at new construction. Resales 2022 didn't have the impact, had the same kitchen, but the cabinets weren't soft close because at that time of 22, they didn't have to put in these same upgrades or additions or to entice them to buy. So new construction, soft close, impact, on and on and on. Looking at the price point, they were at the exact same price point with less upgrades and less upgrades, and 3 years older. So when you're looking at apples to oranges or apples to apples, you can't buy in that year with that new construction. And I don't know how the incentives, come or not with that you're the money guy, but I just saw then the sellers are like, well, give us an offer, give us it. Even if we offered after the incentives of the builder came in, they couldn't compete with the builder today. So you can't. So when you're seeing between the incentives, which I don't know what kind of backhand that is, but between the incentives and then what they're offering and what they bought it at with their mortgage, they can't compete today.
You can't, because it's all built into that price. And someone who bought a few years ago, yes, they have equity, but how much of that equity are they going to want to use to incentivize someone? So what we end up doing is having that real conversation with a listing agent to say, let's get your seller on the phone and make options. There's some ear candy programs you can go out there, like a temporary buy down. You can do a 3, 2, or 1 year temporary buy down. So if the qualifying rate, let's just say 6.5, the first year at the gate, the seller pays for the equivalent of an interest rate of 3.5 for the first year. That's a lot of savings there. Then they'll go up after that year if the buyer doesn't refinance. It goes up to 4.5, 5.5, and then after the third year, back up to that 6.5. But at any time in between, they can refinance. It's a temporary buy down, but it is nice. Now, what are some of the advantages of the resale though versus the new? You buy new. I bought new. I built new. Oh, you want gutters? Okay, no problem. We'll charge you. Oh, you want uplighting? Great, no problem. We'll charge you. Oh, you want a fan? We'll charge you. You buy a resale, it just comes with it, right?
And they wanted $18 a square to lay tile. The same tile that if you bought the resales and you laid it yourself, you can get done for about $6.50 a square.
Right.
So I mean, price points and the construction end of it, of what they charge to do the same things.
And why is it 18 a square? Someone's got to pay for that 23 incentive. Then in all seriousness, that's how they do it. They just charge a little bit for the doors, a little bit for the tiles, a little bit for the extra for the windows, a little bit extra for the roof. And if someone needs the money, you go get it. But where we actually benefit and help a lot of people is we'll get people approved up front. Because we don't give our pre-approvals. We pre-underwrite all of our files. So we'll get them approved up front, even if they go to new construction. And then we start telling them, go check with the new construction. If it's a good offer there, I'll let you know. You need this because you need that money for closing costs. If someone has their own down payment, has their own closing costs, the incentives are nice, but you need to weigh about what is the, what are you really getting? Because again, factor in, you're paying, there is no free lunch. You're paying for that somewhere along the line.
So what are you seeing today, like with families and like financial decisions, poor financial decisions or financial decisions that people are making mistakes on today? What are you seeing from the lending side?
What mistakes people are making? Honestly, one of the big ones is people paying cash, but they don't have a reserve behind it. Think about it. So if someone wants to buy a house for $400,000, okay, I pay cash. The conversation I have always is, okay, what do you have behind it? Well, nothing. Well, what if the hot water heater goes? How are you paying for this? It's so much easier to put down 50%. Okay, and then keep $200,000 in reserve. If after 12, 18, 24 months you don't want it, it's paid off. But what happens up front is it gives you the leverage, because you can actually take, if you have a good financial investor and a good financial plan, you can take that other $200,000. Let's say an interest rate right now is just called 6.5. Can your investments make you more than 6.5%? If they can, why are you burying it in the house? It's dead money. Or if you do want to put a house, pay it off for cash, it's great. Just put a home equity line of credit on it. You don't need to use it, but at least you'll have access to that money in the God forbid moment you ever need it. But the reason why I don't like that, if you do need it, now what? The lender will gladly give it to you and do what? Charge you interest for your own money. I have a hard time with that. So what I always suggest somebody is, look, put your 20% down. 20% down, a lot of people wrongly think that that's the best financing terms. It's not. You'll actually get, most cases, a better interest rate with 15% down than 20% down. Why? It's insured at 15% down. And the PMI is tiny at 15% down. 20% down, there's no PMI to it, so the lender's at risk. Now, it does get better if you put 25 or even 30% down, because now that homeowner has more skin in the game. So, yeah, that's a big misconception.
So, what are you saying today from the investors? Because it used to always be, cash is king. And when you said that, is that going from the investment side? Are you seeing investors hold more money back, doing additional loans to put money out there? And are you getting more investors than first-time home buyers today?
I've lived both worlds personally. Okay, when I started doing personal investing, we get me a 20% down investment loan. Oh my gosh, the paperwork was outlandish. And this is from a mortgage guy. Paperwork was out the roof. The fees are high, but I only had to leverage 20%. Said, you know what? I'm going to go ahead and start paying cash. I started paying cash. Well, that was great, because now it was cheaper to do so. But then also by paying cash, I had a cash come out of my pocket for all of the repairs. And it took my flexibility financially away. So what I ended up doing, That transaction was about 300 grand total that I went out between acquisition and repair. I then took the same $300,000 and I leveraged it. And I have a fix and flip line. Now, granted, you need to be, this isn't I'd like to put my toe in the water. This is, you're an investor. I got a fix and flip line, 10% down with my experience level, and includes the repair costs. So I leveraged that same 300 grand. So I buy one property. Yes, there are fees to it. Yes, there are costs, but I leveraged it into 5 other properties that we have going right now.
Wow.
5. So that's, again, that was just from, it's funny because so many times people ask me my advice, I'll give it to them. And then I look in the mirror, I'm like, I'm going to follow my own advice, dummy. Right. So, but no, when I started following my own advice, I'm like, wow, this is great. This is how it works. Actually, another nice way to do it for cheaper money, if someone has money in, say, Morgan Stanley or in their investment account, you can get a line of credit secured by the amount of money you have in there. I did that to acquire an Airbnb property on the beach. I paid nothing out of my pocket. I leveraged a loan against my assets I had with Morgan Stanley. I then took that, used it as a down payment, got I had put 25% down for that. And I got a 75% loan on it. So the risk is all to the lender, right? Because they're taking 75%. The 25% for the down payment was from my assets that continue to grow in the market. And quite frankly, if I don't make a payment on it, they just take it out of the interest earned each month from that. So I'm like, this is a great, I'm paying it down because I want more leverage in the line. But if I didn't want to pay it, I didn't have to pay a penny to it. And I acquired a property.
You almost could take money out of wash depending on what your investments are coming in at X%, and then whatever you're paying for that loan percent.
Yes.
You almost could now at this point borrow money out of wash without having to pay any interest.
Or you really want to crazy? Charge yourself an extra point. Make money on yourself.
Make money on yourself.
Yeah, absolutely. Yeah. Be your own bank.
Right.
Yeah.
So how are they getting money for the fix? If they're taking out a loan, you have an appraisal, say, they're buying a house for $200,000, and then, they're going to put the 20% down, but they needed some fixed money on top of it. How are they able to get fixed money on top of an appraisal? How does that work?
Great question. When you get the appraisal, they have 2 values. They have the as-is value. This house, as is right now, is worth $200,000. But then they have what's called the after-repair value, or the ARV. They'll say, all right, this house after repaired, and you have to give them a list of repairs, okay? And they submit that during the appraisal. So they'll say, okay, they're putting in a new roof, new flooring, new kitchens, new bathroom, new appliances, and they'll go ahead and say, all right, this house with these values is now worth 3.25. So then I actually have software that I buy, and I spend a lot of money on it, where I can enter a property, and I think the wholesalers love it when I go into properties. I can enter a property, and before I leave, I just say, okay, it's right on my phone. This house is lower end. I have a choice. What kind of appliance package do I want? Economy, mid-level, luxury. I want economy. Boom. It will take AI and search and say, all right, right now at wherever, Home Depot, the High-Sing refrigerator is on clearance for $8.99. And give me the SKU number. I can order it right from there. So I can walk out of these. We have a great roofer, but it'll give me the average roof values of, you want econo, you want mid-grade, or anything. Same for the kitchens. So I can walk out of there before I even go back, and everybody else wants to sharpen their pencil and do their math. I can say, all right, this house you want 200. It's going to cost me 55,000. I'll offer you 255. I could just do it right on the spot, and it's huge. So now I acquire the home. They give me the loan for 200,000 less my 10%, so 190 loan. But they add in 55,000 in almost like an escrow account. Roof goes on. I have to front the money. Okay, so let's say it's 10 grand for the roof. I put out 10,000 for the roof. Roof gets done. I put in a request. Inspector goes out. Roof is complete. Check. They send me 10 grand. But it comes out of that escrow account. Okay. If it's they build a little bit of a contingency reserve in it as well. So that way you never know when you pull off a wall, what's behind it. Right. So you have to front the money and then you get it reimbursed back to you.
So you have to have the nest egg sitting in the bank, but you don't, if you have that, or if you have bills or that unexpected, you tear into that wall, oh no, termites, then you have that little,
That
right. Welcome to Florida. Welcome to Florida. Yeah,
Yeah.
absolutely.
Yeah.
I mean, that's a partner of mine ended up having an investment property, tore off the siding, and right behind the whole frame had to be redone.
Yeah.
So, I mean, that's
The
a,
one we had, it was literally like paper mache. You put your hands through it. It looked great from inside the walls and outside. Gee, I was like, oh my gosh, yeah. So, but yeah, no, you need to. Well, now that we have 5 going, I almost set it up like a conveyor. So I had the first 2 get going. When those 2 moved in the stage progression, I sent the inspector out to get money, and then the next 2 we started those. Then those 2 progressed; they're completed. I got the money, and I just moved it along as a conveyor, so that way. Initially, it was a little rough. Not gonna lie. I was telling my wife, do we need to go out to eat right now? So I need 10 grand for a roof, and she's like, "Well, don't we have the money?" I go, "Yeah, but I have 5 roofs I'm putting on." So now it's a conveyor. So now the one property, the reimbursement funds the next one, and then and it just, so now it's great.
Mhm. Yeah. So if anybody needs to find some investment money for some flip properties, that's kind of your specialty, I see.
Yeah, I get a lot of phone calls when someone says, "Oh, you're buying an investment," you need to call James Cannata. Because, and again, I get the common questions of, should I buy it in an LLC or should I buy it in my personal name? I'm like, there's a bunch of different ways to do it. And I actually, from my mentor, get cracked on because I like an individual LLC for each one, but it's a lot of money. It's a lot of money for accounting. It's a lot of money to set each one up. I just like, it's easier. My wife does all our paperwork. It's just easier for her. But there is ways that you can go ahead and keep it under one umbrella and do it. But we don't pursue that way. Am I probably spending more money? Yes, but it's cheaper to keep her with my wife. I'm keeping her happy. Yeah, you want individual properties? Good. So we have individual bank accounts for each one. Individual. It's a lot. But
So another thing I've been running into is, uh, it seems like a lot of the hedge funds are now putting their properties up for sale now. I think that rental value is skewed on what they can get versus a sale now. I've ran into like 3 of them where they're selling off their assets. Have you heard anything or seen anything with that?
yeah, it's starting to come. I have she's a big RE in the REO world, and she's telling me it's coming. Just simply because, especially in our area, insurance and taxes are just killing everything. Everyone wants to say about the rate. Yeah, the rate's a little higher, but the rate's really not hurting. It's the insurance, taxes, and heaven forbid there's an HOA. HOAs are ridiculous right now. So I know there's some legislation that possibly can come through to curb some of those costs, but it's not here now. It's not here now. But yeah, we want to try to transition out of the rental game. It's just so hard to, unless you're looking for long, and I'm an old man. So I mean, honestly, it's $300 to $500 a door. You're doing well. And to me, I'm like, okay, well, that's $6,000 a year. Oh, $6,000 a year. If I do that for 7 years, that's 42,000. I could just go flip it and in 4 months make the same 30, 40,000. So my wife likes the long-term game, the rental cash flow game. We have a good mix of Airbnbs and annual rentals, but just got to a point we hired a property manager because it was just too much.
What's one thing that wealthy people are telling their children that, average people today aren't?
Great question. Great question. It's funny. I actually say to my children a lot, and between me and my wife, we have four kids, and I'm like, so many people come up to me. I'm like, that is great advice. Or they go up to them. Your father just gave me the best advice. It's so smart, so wise. And I look at my kids like, dummies, I've been telling you this since you were 10 years old. Why aren't you listening, right? But the number one thing is acquire assets and things that go up in value. The dumbest thing people do is and I'm not saying don't go buy a nice car, but go buy a nice car with a fraction percentage of what you're investing every month. Pay yourself first. Religious like clockwork. Credit cards. Oh my gosh. It's, if you're going to carry about And I'm not saying credit cards are bad. All right. I love Dave Ramsey, but I'm not a big proponent of paying everything cash. It's who's paying the credit card. Okay. So if I have a credit card that I'm using, I have 3 credit cards, all with $30,000 limits on them, 0 interest. Okay. How does that get paid? When we put all of the repairs for property on a $30,000 card, then I sell it, that buyer just paid that. Now, if I keep a credit card at 29.99% to Kohl's or Target, and now I'm paying it from my earnings, dumb money.
Mm-hmm.
Okay. I'm not saying don't go buy a nice car. I have a whole bunch of nice cars. But what I end up doing is I buy a nice car, I pay it to 0, then I replace it. I look at people's credit reports sometimes like, how in the world do you have, you make $80,000 a year. What do you have a $1,000 a month car payment for? What are you, nuts? It's devouring your purchasing power. If you took that same car and slid it in half to $500 a month, used the same $500, just put it in, you can increase your house. That's another 70 grand a month, 70,000 in purchasing power. Or take that same $500 a month and go ahead and shoot, invest it in a mutual fund. What's it going to look like? So there's just so much dead, wasted money. People, and honestly, I say this from making mistakes. Okay.
Right. Absolutely.
I made the mistakes, and it's like, another great thing is when people want to go ahead and either pay cash for the house, so they don't have reserve behind it, or they throw extra money at the end of the month towards the mortgage. What a dumb thing to do. Okay. And I don't know if you said, well, can't we pay off the mortgage? I'm not saying don't accelerate payment. Don't do it every month regular. What I would do if I had a mortgage like that, and I don't have a mortgage, but if I had a mortgage like that, what I would end up doing is I would have a separate mortgage fund. At the end of the year, you put an extra, let's just call it $5,000 a year. All right, you have allocated this aside. At the end of the year, you look and say, okay, I have $5,000. Do we need anything for this house? Does it need a new fence? Does it need a new hot water heater? Whatever it may be. If the answer is no, then make a principal reduction that one time off of it. Next year, do the same thing. Now, or you can just let that keep growing, okay? Because at some point, the 5,000 will grow to 10. The 10 will grow to 15, 20. But what happens also, the balance of the mortgage is what? Balance of mortgage is coming down. At some point, the money you're saving and the balance coming down will align. Then you make a decision. Now do we pay the piece off? Sorry. Now do we pay the house off? Because if you're just throwing money at it, and then I got to put a roof on. Well, this roof's going to cost you $27,000. Okay. Again, the bank will gladly give you the $27,000 at an 8% interest rate for a home equity line of credit. And, you don't want to pay us back? We're going to foreclose and take your house. Hope that roof is worth it. If you're throwing the money in a separate account, called the mortgage payoff account, every single month, you're controlling the money. So, and that's where when I buy a car, I don't go to Ally or Chase. When I buy a car, I go to my reserve account. Okay, I'm going to buy this car. $120,000. Great. Not buying it cash. I'm going to finance it from myself.
Right.
I'm paying myself back 9% a month on that money. My wife's like, you are so nuts. It's our money. I go, it's not. Cam Financial is the name of it. Cam Financial that does that money. Then you also write it off.
Smart.
All right.
Right, because there's a write-off.
I'm not an accountant. I'm not a CPA. Please talk to your CPA.
Right. In my opinion, this is what you can do.
Yes.
So, as a former police officer, as an investment banker, as a mortgage originator, what are some patterns that you see in successful people through these, industries, having all these different industries?
Consistency.
Consistency.
And it makes me sick how many times I see someone successful in a spurt, get a little financially fat with success, their head grows a little bit, and then it just goes down the side. And stay humble. Mm-hmm. Humbleness is a key. I'll tell you a story. My wife and I were buying a house under contract for $2.3 million. I negotiated it down to 1.6, 700 grand less. Can we afford it? Sure. is that something I looked at? It's like, I want to watch that. So it was right on the water. I want to watch that sunset. Massive waterway with a boat dock. This is something, we got our grandkids hanging out here, playing here. This is stuff I can look at. And I was in my pool, and of my existing home, and I'm sitting there. I have 3 Rottweilers are all running out of the pool and whatnot. And I sat there and said, you're not being humble. You're not being grateful for what you have. We have 10 houses right now. I have 4 vehicles, high-end, high-performing vehicles. What do I need that house for? Do I want it? Sure. Is it wrong to want it? Absolutely not. But in my heart, I felt like God was saying to me, be grateful for what I've given you. And that doesn't mean I can't have that. It means check your heart. Why do you want this? And I didn't say anything to my wife. The following evening, we went out to a place to eat, the old Italian place in North Swamp, and started talking about it. I started talking about the money it's going to cost for this place. Mm-hmm. And she literally comes out and she goes, James, I got to be honest with you. I know you want this house, and I feel like I'm letting you down by me even saying this. But I want you to know that I just don't feel like that house is home. I feel like our house is home. And she says, can we afford it? Yeah. Do we need it? No. And I literally welled up with tears. I was just like, I feel like God put that on my heart too. I say it was really one of those things like, wow. And we were still in our inspection period. And I said, we reserved the right to cancel within our inspection period. We went out to it. So it was definitely something where consistency has helped me build to where I am at today. And when I say consistent, I don't mean teaming the same thing. I mean, set a plan, work diligently at the plan, relentlessly. I mean, without excuses. So many people want to make excuse. I have a little kid. I have a guy who works for me. I turn around and I told him this. You work like a rich kid. He was like, what? I go, yeah, you work like a rich kid. I said, so here's what I want you to do. Every day that you go home before 3 o'clock, I want you to look your son in the face when you put him to sleep and tell him, I failed you today. And he was like, ouch, why would I say that? I go, because if you're not giving your all, not for you, but for your wife and your 2 kids, you failed that day. You failed your family. They're relying on you. They're literally looking at you saying, I'm trusting you to make sure we are protected, that we are financially safe, that we are secure. And you failed them because you wanted to go home for whatever reason it is. I want to go home a lot, but by like almost diligently, I'm at 8:30 in the morning and 6 or 7:30 at night. I'm in my office till I do every task. Today, I'm here with you. That doesn't mean I don't have to finish my tasks. So I'll be working about 8 o'clock tonight, but that's okay. I love you.
I appreciate you coming here.
But at the end of the day, it has to be consistent. It has to be hard-nosed, and the results will come. And you measure the results quarter over quarter, not annual over annual, quarter over quarter.
I always have to check myself constantly on whose will. Is it my will or is it God's will? You know, and my wife, again, you know, what successful people tell their children, or what wealthy people tell their children, is make sure who you pick to spend your life with aligns with you and with your morals and your faith and your values. Because I see a lot of wealthy people that, you know, I wouldn't be where I'm at without her. She really, you know, she supports me and, you know, puts me out there, and, you know, we have great conversations, but she'll always ask me when, you know, is this God's will? Is it your will? Cause you know, I want this deal to happen. Why aren't they listening to me, you know, in a negotiation, or, you know, this inspection, I've fixed that, or this money. And, you know, she always says, where's God's at? And it's so true. Am I doing it for my will? Am I trying to push this deal along, or is it what's best for them? You know, seller or buyer, either way. So it's just, you know, really for me, a God thing, and checking myself and humble and doing an inventory of the day.
I'm going to give you this. For probably 15 years, every single day when I go to work, this comes with me. For 15 years. It's from Ephesians, but the armor of God. You put on the armor of God every day, the sword of the Spirit. What does God's word say? the breastplate of righteousness, the helmet of salvation, the to do what? To absorb the fiery darts of the wicked one. And I feel that in so many innocent ways, I get presented with things. Hey, buy this house. You can afford it. Why not? It's no different than, hey, come over here. Eve, take a bite of this fruit. Oh, wow. Why can't you? God said you can have everything in the garden, right? So it's the same thing I face all day. It's like so many different things get thrown at me. Well, why can't you have it? It's not that I can't. Will it take me away for God's purpose in my life? And if it is, I don't want it.
100%.
Yeah.
So I have coming to the closing question here. Looking, say 30 years from now or 25 years from now, between your kids and your grandkids, what do you want your legacy to be? Who is James Cannata, and what do you want them to say about you?
He is nothing apart from the grace of God.
Yeah.
Period.
That's it.
Period. That's it.
Well, if you're going to end it like that, end it on the grace of God. Amen. I like it. Hey, man, I really appreciate you coming up, brother. Thank you.
Yeah, this is great.
This is great, man. I thank you. I learned a ton today.
Yeah, right?
It's good knowledge.
I start talking like this, people go, wait, what? Did James Cannata just say that? Yeah, I did. So I don't really say a lot. Like these questions answered, I was just like, I don't know, felt comfortable with you. I just said it.
Awesome, brother. Thank you.
You got it, my friend.
All right, guys. Thank you. There's another episode from the Realty Trader Talk podcast. I'm Jordan Kane, the host. Like or subscribe. Like my stuff, please. Chaser Water, sponsored by Chaser Water. Thank you, Chaser Water, and RealtyTrader.com. I appreciate it. Thank you, guys.